Hey there, crypto enthusiasts. Today we're diving into a prediction that's setting the Bitcoin world on fire. Jack Mallers, the CEO of Strike, is forecasting a massive surge in Bitcoin's price. This prediction is shocking, but yet interesting.
If they're going to have to bail that thing out, that's the holy mecca. That's the final boss. The amount of stimulus it's going to take to bail that thing out and remain solvent, I think Bitcoin lands somewhere between 250 to a million this cycle for that very reason.
Whoa, that's a super bullish one, even for the volatile world of cryptocurrency. But Jack's not just throwing numbers around. He's basing this prediction on some serious economic factors. Let's break it down.
All of that volatility in manipulating the value of money, which is really effectively our time and energy in an abstracted form, causes a lot of stress on the market, one of which has been the sovereign debt market, has been the bond market. So for the first time since the mid 1800s, we're in a very severe bond bear market. So I think it's a fool's errand to say, you know, if I were the chairman of the Fed, what would I do? That's not the game. The game is if you had to finance the government and you had to finance your way out of all these deficits, because Jerome Powell can't say, sorry, I don't care about those deficits. So then what does he have to do? He has to print money.
Jack points to the skyrocketing U.S. debt as a major catalyst. With the debt to GDP ratio at alarming levels, the government's facing a tough choice: default on its obligations or crank up the money printer. And we all know what happens when they choose the latter. Excessive money printing leads to one thing: inflation. As the value of the dollar decreases, people start looking for alternatives to store their wealth. And guess what's waiting in the wings?
So how do I get growth? Where can I just go buy growth off the shelf? Well, Bitcoin is 63% average over the last decade.
Now, here's where it gets really interesting. Jack argues that the current market crash isn't a bad thing. In fact, he sees it as a necessary correction, setting the stage for the greatest bull market ever.
No, I'm bullish. I think this event is actually bullish for asset prices. The total money supply is going up.
His logic: if the Fed can't meet its debt obligations, they'll have to hike interest rates. Higher rates mean more inflation, which means more money printing. It's a vicious cycle that could send people flocking to Bitcoin as a safe haven. So, is Jack right? While $250,000 might seem like a moonshot, Jack's arguments are grounded in real economic concerns. The combination of rising debt, inflation fears, and a weakening dollar could indeed create the perfect storm for Bitcoin. What do you think about Jack's prediction? Is Bitcoin headed to the moon, or is this just wishful thinking? As we bring you more clips from the interview, please take a moment to like the video and subscribe to the channel to help us reach more viewers. Don't forget to turn on post notifications to stay updated with our latest content. Share your thoughts and observations in the comments section below. Thank you and enjoy the video.
My thesis as for this cycle in Bitcoin, and I've made some bold price predictions, is highly predicated on the sovereign debt crisis. So it's the debt crisis, it's the demand for United States government debt, which also is known as the bond market. And so what has happened is you had record money printing through COVID. So COVID, I think, was close to 40% of the US dollars that exist today were printed in the last 4 years. So excessive money printing, which leads to inflation. That's going to inflate the prices of goods and services. There's more currency issued than there are scrambled eggs, than there are Caesar salads, especially than there are Bitcoins, especially than there are Miami real estate, right? Then the way to stop that is to tighten monetary policy, which is effectively deleting dollars from the market, so that if you reduce the quantity of dollars, you're bringing the prices back down. The way to achieve that is to increase the cost of capital, is the interest rate. So they raised rates as fast as possible. All of that volatility in manipulating the value of money, which is really effectively our time and energy in an abstracted form, causes a lot of stress on the market, one of which has been the sovereign debt market, has been the bond market. So for the first time since the mid 1800s, we're in a very severe bond bear market. And so in my opinion, all of this unravels from that core idea, is that we've never been in a worse bear market for bonds, government bonds, unless you go back to 1860. So what actually happened is all of our wealth is stored in assets. You cannot store your wealth, your time, your energy in a fiat currency, because over time, fiat currencies are actively being debased. They're being inflated. They're worth less each day on average if you pan out over a long enough time span. So when they hike rates up as fast as they have and immediately start crashing banks like Silicon Valley Bank, traditionally you run to the bond market. Traditionally you get, risk-free interest rate, 5.5%. Why would you ever own gold? Why would you ever own Bitcoin? Unless there's a crisis in that market, unless those things are down 60, 70%. Then you got to go somewhere else. So what investors figured out is, hold on a second, Japan, they have zero interest rates. They still have no cost of capital. I can actually go borrow money in Japan instead of the United States of America, take the yen, swap it for dollars, and then use the dollars to buy the assets and hide in the assets. And so when you see gold making new highs despite high interest rates, when you see Bitcoin making new highs despite high interest rates, when you see real estate market not crashing, you're seeing Nvidia and the S&P 500 still ripping. Their times are still inflationary despite high rates. So there was still a lot of buy pressure, buy side on assets. And some of that was coming from what we're calling this carry trade, is the world went and found where money was free. So even though the Federal Reserve had the hardest monetary policy as a central bank relative to a lot of the other central banks, the world was still able to go borrow free money, swap it into dollars, and then buy a lot of the hard assets, quote unquote, that the world desires, which are traditionally American-based assets, which are tech companies in the United States of America, real estate in the United States of America. As soon as Japan started to tighten monetary policy, which you can effectively suck in the air out of the room, you say, hey, all that free money borrowing, come back to daddy. Then you start to see these assets sell off. And usually what happens is the financial system, again, it's all on trust. It's all on promises. It's all on thin air. So what you usually see is people get blown out. So what it looks like happened is Monday morning, it smelled like dead bodies in the water. So I think that there are probably some dead bodies out there that had to be forced sellers. It's a difference if you're unwinding a position versus if you're forcefully being liquidated. And you can see that in how violent the markets can get. So it looks to me like someone was caught offside. Someone borrowed a little too much free money and had to puke a bunch of assets that they bought with that free money, which then causes something like Bitcoin to go down 20% and the S&P 500 and the Dow Jones. So that's what happened technically. But I think on a broader scale, when the Fed hikes interest rates, they're trying to get money back into their ecosystem. They want money into treasuries. They want money in the sovereign debt market. They want money in the bond market. And the world is saying, fuck you. We don't want those pieces of trash. We don't understand the deficits you've created. We don't believe in the future of the dollar. And so this is now creating these type of weird market dynamics. I think this will be the first of many sort of really puke-worthy collapses and tragedies where people are like, what's going on? There's no war. There's no COVID. Yeah, but you've got a sovereign debt crisis, and it's just starting to rear its head, in my opinion.
Where do you see this going? Are you still as bullish as ever?
Markets in times of crisis sell what they can, not what they want. If you in real time on a Sunday night owe a bank in Japan $100 million, $1 billion, you can't wait for market open on Monday to sell the piece of shit stock portfolio that you want to give them. You got to dump your Bitcoin. And so what does that do? That naturally misprices assets. You've got a lot of sell pressure on assets that you can sell, not that you want to sell. So that's when you get a market dislocation. So I think Bitcoin is dislocated from where it's probably naturally supposed to be priced, and it will go find that over the coming months. And then I think we're going to get the most money printing in human history. Central banks progressively try and price fix things. In 2008, it was the housing market. And now it's the sovereign debt market. It's the bond market. It's the holy mecca of markets. When people say we left the gold standard and we went on the dollar standard, not really. We didn't go on the dollar standard. Not all the wealth, the richest guy in the world doesn't have a bunch of dollars. All the banks own bonds, right? We went on the government debt. We went on the bond standard. And so if they're going to have to bail that thing out, that's the holy mecca. That's the final boss. The amount of stimulus it's going to take to bail that thing out and remain solvent, I think Bitcoin lands somewhere between 250 to a million this cycle for that very reason. So I don't know all the market events. Like I said, I don't want to be too casual in an economic crisis, but this is exactly how I expect it to go. The beast is rearing its head. They're going to have to print. They've already started. People look at interest rates. They watch interest rates way too closely. It doesn't matter. They cut rates. It doesn't matter. It's how much money is there out there, not the cost of it. They are printing. And so I think Bitcoin makes a historic run.
So, what do you think of the job that Powell is doing? And, where do you think we're going from here?
The problem Jerome Powell has is he's trying to beat inflation. He's trying to get it back down to his target, 2%, which, by the way, inflation should be 0 or negative, but whatever, we'll do 2%. The only way he can do that is continue deleting dollars, continue to raise rates, right? But that's not clearly what he's optimizing for. He's optimizing for an orderly market in treasuries, which is what Janet Yellen would want. So we live in a period of fiscal dominance. So what do I think he's going to do? If he actually cared and he was actually doing his job, you're right. He would have raised rates more. We'd be at 10% rates, 15% rates. All the banks are going to go under. But fuck the banks. Why would we care? You want to fix this problem? Remove the government guarantee that banks get bailed out. Remove FDIC insurance. Tell customers you can go anywhere. Stop criminalizing Bitcoin. Let people own what they want. Deposits will flee out of banks. Banks will be realized as insolvent. They'll all fall apart. We'll reset. If Jerome Powell could do what he wanted, that's probably around the range or direction that he would do. Maybe I'd be a more aggressive Fed chairman than Jerome Powell, but that's what he would do. He'd fix the problem, but he can't because his boss is Janet Yellen. And what Janet Yellen needs is one rule: no one sell their treasuries. No one. If Japan's in trouble, we open a dollar swap line because they're going to sell treasuries. So the game is no one sell treasuries. So if that's the game, and you're going to continue to need to finance this market and this government, then you got to print. So I think it's a fool's errand to say, if I were the chairman of the Fed, what would I do? That's not the game. The game is if you had to finance the government and you had to finance your way out of all these deficits, because Jerome Powell can't say, sorry, I don't care about those deficits. So then what does he have to do? He has to print money. And so whether that means lowering rates or not, I don't think is that important, right? Like there's a difference between the cost of money and the quantity of money, to your earlier point. He can still print without changing rates. Now we realize how important rates are by looking at what Japan just did, right? Rates are important. Like you can crash a lot of shit by clicking the wrong button. So not to say that he won't make changes and that they won't make changes and coordinate with other central banks around the world, but I don't really think it matters. I think they got to print a lot of money no matter what. And I think you're going to see one of the biggest asset bull markets in human history because according to the math of the money they have to print, you're going to get 2, 3, 4 COVIDs of money printing. So I think we're living in fiscal dominance, unfortunately. And it doesn't matter what Jerome Powell thinks or wants because his boss is the government.
There you have it. Jack's insightful analysis of the bond market, interest rates, inflation, and his Bitcoin predictions for this cycle. What are your thoughts on Jack's discussion? Do you think $250,000 per coin is achievable by the end of 2024, given the factors he highlighted? Share your comments and observations below. Don't forget to like the video, subscribe to the channel, and share it with others. Thanks for watching.